Welcome in, folks. What an absolutely brutal one I have for you here today, okay? Oh, baby. It's a three-piece, and it's all bearish. First one up here we're going to react to. Citigroup expect a hard landing for the U.S. economy. That should be interesting. Then we're going to get into this one. The only way we could get rate cuts is if something broke. And then the last one up here, this one came out last night. It's about 19 hours old. These other ones are 6 hours and 2 hours ago. This one, market is very expensive right now, warns Mr. Emanuel. So, boy, if you guys can make it through this one, you can make it through anything. This is going to get dark. It's going to get bearish. Appreciate y'all joining me as always. All I ask in return takes less than 5 seconds. Hit a like on this video and make sure you're subscribed here to the channel because this is going to be an interesting one here today. By the way, tomorrow I'll be going live on Twitch. I'll put that as a pinned comment down there if you want to follow me on Twitch. The reason I'm going to be going live on Twitch tomorrow is NVIDIA earnings, ELF earnings, and Snowflake all after the bell. It's going to be insanity. Obviously, NVIDIA, most important stock in the market right now. Let's get bearish.
Our next guest has been a longtime proponent of the idea that we're going to get a hard landing here in the U.S., predicting 4 rate cuts from the Fed starting in July. Here with us at Post 9, Citigroup chief U.S. economist Andrew Hollenhorst. And we ask you what...
It's so bearish I had to put my hat backwards. You know it's bearish when I got a backwards hat.
You are seeing that the market is not to suggest a July cut and a hard landing.
So I think there are 2 ways we can get to the July cut. We can get to the July cut on a hard landing and a weakening in the activity data. We also might still be able to get to July on slower inflation. And I think that's part of what the market is reacting to with Governor Waller's comments. Yes, he's looking for several more good inflation prints. Will we have enough by July? That might be on the edge for him. Is Powell a little more dovish than that? That's what we have to wait and see. On the hard landing there, what we're really looking at is what's going on in the labor market. That's what's most convincing to us, where we're seeing a weakening. And I'm not talking about the establishment survey payrolls data. That data has been stronger. It did weaken in the last report, but 175,000 new jobs per month is still a solid pace of job creation. What I'm talking about is if we look at a little bit more disaggregate data. If I focus in on the small and medium firms, for instance, we have the NFIB Small Business Survey. Small businesses are telling us that their hiring intentions are at the lowest levels that we've seen since 2016. And if I look overall at the economy, the hiring rate right now is at the lowest rate that it's been at since 2014. So we're at the lowest hiring rate in a decade.
As far as those small business expectations, they've been a pretty...
So there's 2 ways you could look at that. 2 ways you could look at that, okay? I'll give it to you glass half full and half empty in this situation. One, you could look at it and you could say, you know, this is proof that things are getting worse. They're going to continue to get worse. We're going to end up in a big recession. Unemployment's going to go up 7, 8, 9%, whatever number, right? And so you could look at it, there's definitely a way of looking at it glass half empty. Let me give it to you glass half full. Okay, we could say, I mean, it doesn't get much lower than this in terms of confidence. If you look at Consumer Confidence Survey, Michigan Consumer Confidence Survey, if you look at the Small Business Optimism Index, these are, you know, I don't want to say the lowest they've ever been, but they're not far off. And so when you look at it from both those perspectives, you can say, well, if anything, maybe things get better over the coming years. Maybe they don't get worse, right? Maybe we're just been going through hard times for the last several years, and maybe there's much brighter days ahead when inflation isn't slicing and dicing people for 3 years straight, right? So you can, like I said, you can look at it glass half full, glass half empty, and that's what you have to really do as a market participant in order to be equal, in you know, have some equilibrium in this game. You have to be able to look at it from both sides, the bearish side, the bullish side, and do that in regards to individual stocks too. I always look at my stocks and I say, okay, what's the upside potential here? What can go right? What can go wrong? I just did my Palantir numbers last night. I updated all my Palantir numbers, right? And guess what? I have an ultra bearish case for Palantir, a bear case for Palantir, a base case, a bull case, and an ultra bullish case. And the reason I do that is because I got to be able to look at it from all the different lenses of like, okay, how bad could this get? What does that mean for the stock price? How good could this get? Right? That's you gotta be able to look at it both sides. If you only look at it one side in this game, you're in trouble.
Hell, though, for a while, they've been low throughout last year. The unemployment rate hasn't ticked above 4%.
So we've had a lot of false positives for recession in the data, and this really goes back a couple of years, right? People were looking at the yield curve and seeing an inverted yield curve. Usually that's been a good recession indicator. So what you're saying is absolutely correct. There's been a lot of false signals.
Especially on the softer data, the surveys.
Especially some of the surveys. We've had a lot of volatility in the survey data. With the NFIB small business, this is a sharp move lower that we've seen just in the last 2 months. So I think we are seeing something new there. And we wouldn't just look at one of these surveys and say, okay, that's convincing evidence to us. What we're doing is we're trying to look holistically across the broad array of labor market data. You mentioned the unemployment rate. 3.9% is still a very low unemployment rate. Nobody would argue with that. But it's come up from a low of 3.5%. And again, that's showing us that maybe firms aren't laying people off yet. We think that they're not. There's some labor hoarding going on. But firms are hiring at a lower rate. Firms are having workers work less hours. So this gradual softening has already started. That tends to snowball and end up in something that looks more like a hard landing.
Ian Shepherdson's got a great piece today looking at his home-based data model, implying a 150 handle on May jobs. Would that be out of line from what you see?
I think it actually makes a lot of sense with the data that we've seen, where we've had this slowing in the establishment survey, payrolls numbers, 175,000 in the last report. And one thing I'm looking at is not just what's the overall number on hiring, but where are we seeing that hiring? A lot of the hiring that we've had has been in two sectors, healthcare and government. Healthcare was still strong in April, but government slowed down. And to me, that's saying maybe this boost from fiscal and from government, maybe that's finally starting to fade a bit, and that could be less support.
You think a 4% unemployment has been overstated as a trigger that would prod the Fed to action?
So I think Chair Powell was clear on this in the last FOMC, where he said, look, 1/10, 2/10 on the unemployment rate, that's not really going to provoke us to do something. But if we get above 4%, which is where the Fed thinks we'll be at the end of the year, they've been technically surprised to weaker labor market data. And if they see that in a broad array of data, then that's where I think you can say, okay, maybe they can be cutting in July. Maybe they can be cutting more than what the market's pricing right now.
And you think this is all happening because of...
Before we go further here, let me share my thoughts on, if we could get actually a hard landing in the U.S. economy. Okay, so as of right now, I would say, doesn't look super probable of hard landing. It's certainly a possibility, and you have to take all these things into context, right? But as of right now, unemployment's still very low. Now, that could be a lagging indicator, so that can always go up in the future. That's true, right? But as of right now, the employment market is still pretty decent, right? Is it as good as it was, some years back? No. It's not that good. I'm home alone. The door just closed by itself. So, I could look at it from that perspective. Okay, do I feel like there's a lot of toxic debt out there? You never really know what's really in the banking system, so that is something to kind of be wary of. What are the investment banks on Wall Street? What are they up to? What do they have on their books? The good news is we've been in higher interest rates now for really at least a year and a half. So, if something was going to break, it probably would have already broke in regards to the banking system. Do I feel like individuals have a lot of toxic debt? Well, if you look at credit card balances and you look at where we were prior to Rona, if we just stayed on a regular trajectory, we would be right here where we're at right now, or maybe even a little bit higher, right? We went down, obviously, in Rona because people stopped traveling, they stopped spending. Some people stopped spending as much, right? And so the numbers went down and then they came back up really sharply. So it made it look like it's more extreme. But if you just take, go back to 2019 credit card debt levels, right? And then just run a projection on kind of, if things had just stayed normal, they would have kept climbing, right? Credit card debt has been climbing every year since probably 2011, 2012, and up and up and up. We would be right about here. So I don't think credit card debt's necessarily something crazy. And honestly, credit card debt should be 2x what it is today, 10 years from now, 15 years from now. So if you want to say we got a little over $1 trillion in credit card debt, honestly, we should have $2 trillion plus. 10 years from now, that's the way it should work as the system gets bigger, as there's more money in the system, as the economy grows and those sorts of things, right? So housing's a problem. We all know that, right? In terms of pricing being so high, and then you got the super high mortgage rates. But at the end of the day, it's hard to really get housing to crash because low inventory, right? And people still have jobs. So, it's when people go way underwater on their homes. Like, let's say you buy a home for, $600,000 and then a home's worth $400,000 or $350,000. That's a situation where some people say, okay, let me walk away from this home, right? That's what you certainly had happen in a lot of markets throughout the United States in the great financial crisis. And then you also had people lose their homes because of balloon payments and also because, of job losses. So I don't think you can close the book on a hard landing, but I also don't think you can have a strong justification for a hard landing, right? People have been calling for a recession for several years now at this point in time. And we certainly haven't been in the greatest boom times when it comes to the economy, but we certainly haven't been in the worst either. There's been, far worse times than this over the past couple of years. But I can also go back to periods just in my adult life where I felt like the economy was maybe a little stronger than where we've been at, because you didn't really have the inflation drag in there, and it felt like businesses were more looking to hire than fire. If I just looked business landscape over the past, I would say year and a half, it's felt more like, actually, I'll just say 1 to 2 years, it's felt more like companies are looking to save money, right? If anything, it feels like companies for the most part are looking to, axe employees rather than hire employees. And I can tell you from much of my adult life, it has not been like that. I haven't really seen that since I, kind of got started in the money game back in 2008, 2009. And so, that's kind of what I'll say about that for now as far as hard landing.
Impact of higher interest rates, the highest in more than 20 years?
Extended period of high interest rates, that is finally having an effect, again, more on the small and medium businesses than the larger businesses. And then also the fact that prices have come up and savings have been run through. I think we're seeing that in a lot of the corporate earnings where we have retailers talking about maybe needing to lower prices now. So this really strong engine of consumption, consumer spending, demand, that finally seems to be slowing.
On the flip side, those who say we're not going
to... Which could be deflationary, right? So Target makes their big announcement about they're going to cut a bunch of prices on food and whatnot. It's deflationary, right? If anything, that helps the consumer. Because if Target lowers price, then Kroger might look at that, or Walmart might look at that and say, dang, they're going down. We don't want to lose any market share. We know in grocery, you do not want to lose market share. You'd rather lose money in the short term than lose market share long term. Because if somebody's used to doing their grocery shopping, right, at your particular store, they might be a 5, 10, 20-year customer of being used to being in your ecosystem, right? So if anything, that becomes deflationary, which then ends up helping the consumer, ends up helping bring down inflation numbers, right? So, but deflation also is usually a sign that you're in a recession, right? Last time we really saw any sort of real deflation in the system was back during the great financial crisis. So that's a little food for thought in regards to that, no pun intended.
Landing, they point to the fiscal spending and the fact that it still is flowing from different
true.
projects, whether it's infrastructure or chips or IRA or...
Good point.
I mean, the money still from the Stimulus Act from when President Biden first came into play. And that still is having an impact, isn't it?
It is still having an impact. And that is one of the factors that makes it so hard to forecast this economy, because it's been a lot more fiscal spending than we usually get. And that has probably extended this cycle longer. I was mentioning the strong hiring that we saw in the government sector. That doesn't just support the government. That's wages that go out into the economy. That supports broader spending. So we're trying to get a sense for if that's slowing down. Now, we know some money is still coming out. CHIPS Act money, for instance, is coming out just now. So that is a big complication in forecasting the economy, but we do think it's fading from what it was a year ago.
That's
okay. No. Andrew's sticking to his guns. Thanks for coming on.
Thank you.
Appreciate it. Andrew Hollenhorst from Citi.
That's where it gets so complicated, right? And I think that's why everybody making their recession calls, they all really got it wrong. Everybody was expecting this dire recession we'd already had been in, right? And unemployment, massive unemployment and all these sorts of things, right? And the reason I think that call hasn't been correct is, one, Fed lags take time to kick in. Two, there was so much stimulus money before we ever went into hiking rates, right? So that's something to factor in. And the third component is obviously the government's still spending aggressively. So when you take all that into context, it complicates things, right? If it wasn't for all that previous stimulus money during the Rona phase, and if it wasn't for the government continuing to spend, maybe we're in a different situation right now. Maybe we did have the big recession. Unemployment would be 10% right now or something like that. But, it's a complicated matter. Next one up here. The only way we should get rate cuts is if something broke.
Director of Research at Ironsides, macro economics. The sectors you're in, even though you have a pretty good cash position, the sectors you're in are aggressive. So you say you actually have a higher risk than just the S&P itself.
Right.
So you're bullish.
Oh, wait.
Essentially bullish equity.
I thought this was going to be a bearish video. Okay, we might go bullish. Let's see. Let's flip it around. Let's win a little bit, huh?
Really bearish the back end of the Treasury market. So in a lot of ways, the setup is like the 1960s, where bond yields just made a series of higher highs as inflation was rising and Fed rate repression was receding.
Hey, quick question for you guys. Quick question. Let me know in the comments. Which card do you like better out of these two? One's a 1000X membership card we send to 1000X members, and one's my private group card. Let me know. I'm really curious which one you guys like better. Let me know in the comments section. I don't know. I like them both. If I had to pick one, and I like them both, I think they're both really cool. They actually are much more cooler in real life. They're both steel. But if I had to pick one, I like the private group card the best. And you don't even know what stock that is. That's an actual stock chart of an actual stock. I'm not going to tell you which stock it is. You might know. And the 2023 edition, by the way, is different than the 2024 edition. So, yeah.
Following that rate caps.
That's all changed with the last CPI number, hasn't it?
Well, I think what CPI really said was, first of all, the volatility of inflation is falling a lot. I'm totally in the camp that we are not going back to 2%. We're going to stay 3.5.
Oh.
But the key is that standard deviation of inflation, that volatility of it has fallen back to 1960s, 1990s levels. At that level, parts of the equity market can operate really well, actually. If you're a high fixed cost business like an industrial company, an energy company, a materials company, you have higher nominal sales, you cover your fixed cost, it creates positive operating leverage. So for those industries, they thrive in a higher inflation trend environment. And that was similar to the 60s. But for other industries, like the banking sector, for example, with the deeply inverted yield curve, they really struggle in that environment. And so, yeah, those sectors are definitely aggressive. If you're all in on tech, industrials, energy, materials, by definition, you have very aggressive positioning. So for me, holding cash in the eventuality that one of two scenarios takes place. One is 10s make an impulsive run up to 5, and then we have a broader risk off. Or we do get a growth slowdown, which I think is highly improbable given the amount of government spending we have right now. To forecast a recession with a 7% budget deficit.
Stagflation is not in your
I wrote a report like 3 weeks ago. I said, essentially, there's plenty of there's no stag, but there's lots of inflation. And I think that's the operating environment that
you allow for the possibility of the weight weakness in the labor market, but you don't think that's what's going to happen. If there's a 10% pullback, it's going to be caused by 5% being breached by the 10-year again.
Most likely, yes.
That would be from inflation. That's not good what you're saying, 3 to 3.5, because if it stays there, we're not going to get any rate cuts. We're not supposed to.
Well, the only way we would get rate cuts is if something broke, right? There was a real problem in the financial system or...
How many years of 3 to 3.5?
Just take it out.
Like years? Yeah, you don't need that. Yeah, years?
I think for the foreseeable future, for me, the only way we get inflation back to 2 would be if we had a significant tightening of fiscal policy. And that would involve cutting government spending from 24% of GDP down to 21, 22, which...
We don't have a candidate running that would do that.
It seems highly unlikely because you can't get there solely through discretionary spending. We've ramped up the amount of spending we're doing on, Obamacare, Medicare, Medicaid expansions, healthcare, then all the infrastructure spending, the renewables bill, so-called Inflation Reduction Act, CHIPS Act, Infrastructure Act, all those things are keeping government spending running at levels. I've said this a couple times before. When I studied econ in the early 80s, early 90s, no economist would have forecast a recession with government spending at 24% of GDP and deficits at 7%.
We forget that.
That's a valid point, sir. A valid point overall. I mean, his whole point, excuse me, there about, I think it's a little ridiculous to assume we're going to be at the CPI 3.5%-ish for, a long time to go in the future. You would need energy to go on a major multi-year bull cycle, in my opinion, because that's a huge component of that. Can housing really stretch and go up significantly from here over the coming years? I don't know about that. I mean, my thought in regards to housing is prices probably stay pretty stable or maybe even fall a little bit over the next few years. So, that takes the shelter component kind of out of being a problem. But I don't know, I guess all things are possible, but it's just hard for me to see that. But also remember, ever since I really came into the financial world, I never even, inflation was never something we even had to worry about. Because when I first got on the game, 08, 09, it was deflation, right? It was about cheaper prices. It was about, if you're a business, you're a company, you better be, value conscious, right? It was all about, the cheapest prices possible. And so it was a very, very different phenomenon. So I don't know, maybe he could be right. It's just hard for me to see a CPI 3.5% for a continuation of, let's say, another year of this, 2 years, 3 years, outside of, once again, a multi-year bull cycle in energy. Market is very expensive right now.
Market forecaster thinks it is the wrong time to go bullish on stocks. Julian Emanuel is the firm's senior managing director. His S&P 500 price target is more than 10% below today's close. Julian, welcome. Is it harder and harder to stick by that forecast as markets go higher and higher? Well, by definition, it is. There's no question about it. But let's think about it, right? The first 10 minutes of this conversation, we've been focused on valuation. Mm-hmm. It is something that I would say in the course of years of me being with you all, we've talked about very, very little. But the point being that, whether it's the consideration of earnings estimates that in our view are far too high, even though we had a good earnings quarter, but good earnings quarter was up 5.5%. The market thinks the full year is 10.5% at 23.5 times earnings. Whether it's the premier investment bank stock in the world, or it's the market in general, we just think this is a time to really think about risk reward here. Goldilocks, despite the fact that we're either at 2 or 1 or 0 cuts, continues to be priced very aggressively.
I think that's why you got to be balanced in this market, right? You guys know what I've been preaching to you. Be invested, right? Own the greatest companies in the world. Whatever happens, right? Recessions, no recessions, inflation, deflation, blah, blah, blah. Own the greatest companies in the world. 10, 15, 20 of the best, right? Own those. Buy, great companies that are at big discounts, right? That are at 52-week lows, multi-year lows, somewhere around there roughly, right? That the pricing is very attractive on great companies, right? And great assets. The stock that came to mind when I was thinking about that, Nike. Nike came to mind, right? Take advantage of those opportunities out there. Wynn Resorts, another perfect example, right? Take advantage of those opportunities out there. Keep some cash around. You can get 5%, if not over 5% on money at high yield savings right now, treasuries, if you got a high yield CD account, right? And make that easy money, 5% plus right now. Be balanced in this game. So that's my perspective. If you own the greatest companies in the world, they're going to perform. The stock price could move around. If all of a sudden the S&P 500 dropped 20, 30%, could the stock price go down? Sure, in the short term. That is what that is. As long as you're always got more income than expenses, you can buy the dip. And if you've been keeping some money in cash, earning you 5% plus, boom. And there's some major market drop, say S&P goes down 35%, boom, oh my gosh. Well, if you had some money there sitting over on the sidelines, 10, 20%, right, earning you 5% plus, and then you get that epic drop, right, boom, you're ready to deploy money in the market, right? And at that time, by that time, I mean, I can tell you if the S&P 500 dropped 35% or something insane like that happened, Fed's moving rates back down to zero in that situation. We know they would be in full panic mode. They would start lowering rates aggressively way before you ever got to 35%. And so they would be in full-blown panic mode. And so then you wouldn't be able to get your 5% over in cash, which then makes sense to buy assets aggressively at that particular time and take cash balance down very low, other than obviously having always cash for emergency expenses. It's an easy game, man. It's that easy game. People make it much more complicated than it really has to be. Shoot, man.
Yeah, it makes me crazy. I'm giving Julian a pass because
if I figured out this, a college dropout, you guys can figure this game out. This is not nearly as complicated as you might think.
We just don't talk about it on Turkey Day. We'll talk about gold in a minute, please.
But I mean, in terms of where we are right now and the risk reward, one of the big risk events in the markets we've been talking about for weeks now is NVIDIA's earnings, which are coming up this week. Volatility is still extremely low right now in general for the markets. And so I'm wondering how you reconcile that. And if you also think that, like many of the traders here, that NVIDIA is actually going to be sort of the thing that either sets this rally higher or sets us back.
So it is one of the most unusual environments I think any of us have seen, because the amount of dispersion among stock returns is really record, which is why the index doesn't move. Think about today, right? We saw, Jamie Dimon's bank sell off the way it did. At the same time, we had 2+ billion shares in a number of meme stocks that, frankly, people don't know what the companies do and never even heard of them 2 weeks ago, buying and selling them. So it is a very unusual environment. And to us, in total, it says that risk in general is perhaps overpriced here. And it's not the end of the bull market in our view. And I think that's the message we got from Jamie Dimon today. It's just a time to sort of let things settle in for a while.
Julian, what's the deal with the VIX? I mean, we talk about the headwinds all the time, geopolitical stuff, blah, blah, blah. Closed below 12 on Friday.
It's incredible. It goes to the dispersion. It also goes to the fact that the game has morphed for now into one-day options, 0-day and one-day options. The one-day VIX today traded in the 5s, the lowest ever for the 2 years plus that it has been calculated. And from our point of view, when you think about it in the context of NVIDIA, it is true. That stock has been the market for the last year, and it's going to move. We're not sure which way, but the options market says it is going to move, and we expect the S&P to move with it.
All right, Julian, the stock market hasn't worried too much about where yields are, right? And again, even when we started the year and there were 6 cuts that were priced, and now, we have maybe 1 or 2 this year. Let's talk about inflation for a second here. So if the Fed keeps saying that, 2%, they're going to stay pat with like higher for longer, that sort of thing. At some point, do you have to start figuring out what the cumulative gains have been since we got above that 2% and kind of took off into 2022? Because, do they have to actually keep yields much longer for, higher for longer than a lot of folks think that they might have to do because of those cumulative gains over the last few years?
I think that's some of the dialogue. And as much as we may not want to acknowledge it, there's no question about the fact the feedback loop from equity prices into confidence, into financial conditions is definitely there and has been for a number of years in central banking. And, people want to compare this to 1995, the dawn of the internet revolution. We're fully behind the idea that generative AI is going to be a game changer over the long term. But the difference between now and 1995, where you basically had a straight shot up for 3 years uninterrupted, is the Fed started cutting rates into the kind of economy we have now when inflation was already 2.1% versus 2.8 now, and stocks were trading 14 times, not 23 times.
Fair play. In terms of the market, here's what I'll say, okay? Do I feel like the stock market is overvalued? The answer is, I can't say it's overvalued. Can I say the market's undervalued? No, I can't say that either. I think we're probably on, somewhere in the middle, or maybe more toward overvaluation than undervaluation, if I'm to look at the whole entire market. But that doesn't mean there's not a phenomenal amount of opportunities out there, because there's opportunities all over this market, okay? Appreciate you guys joining me as always. Thanks so much for being here. As pinned comment down there, I'm going to put my Twitch channel. Also put my brand new workshop I have for you guys that's free to access. Goes into 7 steps to $1 million plus in stocks. So yeah, hope you guys enjoy that. Thanks for joining me. Much love and have a great day.